this is, I mean, a pretty decent start out of the gates, right at the word go. The mid-cap index is flat to slightly higher, and the small-cap index will come up on your screen as well. The heat map, 30 up, 20 down. That's the overall picture as things stand right now. You can spot a bunch of financials, not the big ones, the big ones as well. But there's IndusInd and Bajaj Finance along with Zomato. That is eternal as far as the gaining corner is concerned. Surabhi.
Oh, that's an eternal performance, at least as far as yesterday and today is concerned. Look at that, 10% on eternal. And mind you, a lot of the price targets that we've just heard from Mangalam as well, they're still northwards of where the stock is right now. Price targets of the bullish camp are ranging anywhere between 320, going up all the way to 400 rupees on eternal, with Jefferies being the biggest bull. They have that 400 rupees price target on the stock. What a move. Okay, let's go beyond eternal and see what else is working for the market. Bajaj Finance, like we were discussing earlier, actually Mr. Jain has been such an old hand and responsible for such good business and growth in the company that his return, even though it might be interim, it's being seen as a positive. So 1% higher on Bajaj Finance. Trent is up 1%. IndusInd Bank is rising about 2%. And HDFC Bank is still continuing its good show from yesterday, as is ICICI Bank. So yes, both the banks are still firing and firing well. In fact, even Axis had joined them last I checked. Yes, there's a little bit of green on Axis Bank as well. So overall, large cap banks are looking good. The bank Nifty is outperforming the Nifty at this point in time. Very quickly, just to see the downside of the screen, Reliance is still dragging. Reliance is down about 0.5%. Eicher Motors is a bit weak. Kotak Mahindra Bank and Infosys are some of the other names, but no problems. Eicher and Reliance are the only noticeable losers. Otherwise, it's a pretty good solid start. 73 higher on the Nifty now.
Well, that's right. Let's pull up a few stocks. The street is saying, let's look at Zomato. But some part of the street is saying Zomato is locked in upper circuit. Let's look at Swiggy. And it's swigging its way right now. That one, in fact, is up close to around 5%. Big move is what we're seeing on that particular name. AGI Green, that's the other one that's moved up on rather good volumes. The numbers look quite good. Revenue growth of 20%, EBITDA growth of around 20%, and net profit jumps up by around 40%. Street likes that, 5%. That one is flying away. IndusInd Bank, Street believes maybe, in fact, the new CEO, new MD could be pretty much, sooner rather than later, at least for the time being. Volume's massive on that one. Stock is up close to around 2%. After Ritu put out that clarification, in fact, yesterday, the stock has gained close to around 5% from the lows. Well, pull up Tilaknagar Industries as well. They have put out that clarification, rubbishing those claims, saying that it's quite dated. They've submitted everything they need to do. The volumes are very, very large. Remember, yesterday the stock was around 440 rupees. It corrected to around 410, and then it saw a big pop-up. More than 3 crore volumes yesterday. But the clarification has helped because the stock is moving back towards the high that we saw yesterday. BL Kashyap, that's the other one that's won an order out there. And that's the reason why that's moving on very, very large volumes. Keep an eye on some of these capital market plays as well. BSE, case in point, that's buzzing around. Jane could be back, probably. So that one, in fact, is up close to around 1%. And I'll pull up Angel One as well. That's the other one that could possibly be in focus because it's come out of the F&O ban as well. So that one is well up close to around 2%. One of those two stocks that I said could be, stocks in focus. Angel One as well as Hindustan Copper. Both of them coming out of the F&O ban, and they have some tailwinds as well. 361 WAM. Large trade getting cleared out. Nimesh told us, keep an eye on that one. 2 crore shares changing hands.
So Eternal and Swiggy are the top two volume-led gainers in the market right now, the NSE, by far. So, 10% locked up, Swiggy 5%. So, the Eternal results doing some good for Swiggy as well. Up on your screen, and very large volumes in Swiggy right now. Paradeep Phosphate, was a big mover yesterday. It's up another 2.5%. And the only reason I'm mentioning this is because it's the third biggest volume gainer on the NSE. There is Afcons, which is up 2.5%. Nuvama, this is on the back of, the Jain if you want to call it relief from the regulator. They deposited money, and with ample supervision, they are going to be led back into the market. But Nuvama is a broker. There is, what else? Religare is up 3%. Decent volumes for this point in the day. MRPL, Nigel, you were talking about MRPL and CPCL yesterday. MRPL is up 4%. So 145 on this one. There is Naukri, Info Edge, which is up about 3.5%. Latent View is coming up with a beg your pardon, 3.5% pop right now. So it's basically 4:1 advances to decline. It's still early and we'll have to wait, but it's looking good. 361, of course, that block, and that's why the volumes are humongous. Anthem, which listed yesterday with almost a 30% pop on the top of the issue prices, down 3.5%, nothing very large. And I can spot a Voltas, which is down about 2.5%. Maybe throw in Supreme Industries and Parag Milk, which are also down. Supreme is down 2 and Parag is down about 2.5%. I mean, just some stuff with over 2% moves with volumes on the downside as well. So that's the overall picture. The Nifty has got about 30 points on it.
Yeah, just a point, since we're talking about those refiners, Prashant, Yes Securities, they have been quite positive on it. And yesterday they put out this note about global refinery closures could indicate a medium-term tight supply. So MRPL yesterday was down. It's made up all those losses. There was a Concall as well, and CPCL as well. That was down more than 5% yesterday. That as well has made up out of it. Very, very tactical. Remember, you need to be very careful. GRMs are very volatile. But for the time being, the street, is reading the commentary coming from MRPL positively.
Absolutely. Well, let's welcome in Manishi Chaudhary, who's with us. He's Chief Executive Officer at Emma Capital Partners. Manishi, good to have you with us here on the program. Thank you. Just a quick word, Manishi, on the earnings season that we've seen so far. If you've compiled and looked at the entire stack which has come until now, and how does it compare to your expectations, and what does it mean? I mean, very soon, if we've not already done it, many have already done it, you start looking at FY27 numbers. Go on, Manishi.
Right. I mean, we're still in the, looking at the first quarter of FY26. So by the time we start looking at FY27, it'll possibly be towards the end of this year, end of this calendar year. Now, the earnings season has been, mixed at best. So if you look at the large banks, not all of them. So Axis Bank was a disappointment because of, that's a quality issue. HDFC and ICICI were okay. IT services, on the other hand, were a bit disappointing. One would expect them to be so if the US and the entire Western Hemisphere are going through an uncertainty. So, at this point, it's still very early stage, but at this point, the earnings season is mixed at best. What is perhaps more important is the earnings estimate trajectory. And this is the point I've been harping on, on your channel, on several other media interactions. Earnings estimates for India, after a brief interregnum, after a brief recovery, I think around March, April, they're again on their way down. And this is happening across all sectors. It's happening across even those companies which have reported reasonably better results. It's happening across financials, across IT, across consumer discretionaries, across industrials. That is, a bit scary, especially for a market which is still trading at premium valuations, notwithstanding the correction that we have had over past months. So that is the key issue that I, and I'm sure many other market participants, would be watching for the foreseeable time horizon.
All right. Manishi, hi. Good morning. Great to have you on. Food delivery and quick commerce. I mean, it's such a strong debate, and all those who remain believers in Zomato, when most of these companies came out and said, right, that we're expanding our dark stores, there's going to be cash burn. But those who remain believers, they're being rewarded today. But what do you think? I mean, is this just one quarter? Should we be cautious? Because a lot of the broker notes this morning are saying the worst is over. I mean, market share gains are great. They have a very strong going out business that they're building as well. So, gets a little heady when you have this kind of commentary. So what's your view?
In the short term, they do look good, in these quick commerce and food delivery companies. But if I draw, from the experience in China, these food delivery companies, despite skyrocketing growth, skyrocketing top line and volume growth, the stock prices have, kind of collapsed. I wouldn't say collapsed, but they have underperformed significantly simply because of one reason. And that's unbelievable degree of competition between the likes of Meituan and JD, and even Alibaba has its own food delivery outfit right now. So this is something we have to be careful about. As of now, India is kind of a benign oligopoly, and we haven't seen that crazy market capturing price war But, it is something, if I take some kind of a leaf out of a larger market, which is China, and which I'm much closer to, this is something we have to be very careful about.
Manishi, but what's your take on
And sorry, just to complete that point, Nigel, once again, I completely take your point on competitive intensity, which is why I think we need to see if this is the last of it or not. On what about valuations, Manishi? Because Mangalam, our colleague, was just telling us that on one-year forward earnings, Zomato is trading at over 70 times. So it's not like you're getting it at a rock bottom valuation either. So again, just give us the valuation comparisons as well to a market like China.
That's a great point. That's a great point.
Yeah.
And think of an international investor sitting in London or New York or Hong Kong who has the entire canvas to choose from. So he can choose from Zomato or Swiggy trading at maybe 60, 70 times P multiple 1 year forward, or Meituan, or any of the others like JD. I mean, these are not pure, pure food delivery. Meituan is, but these are trading at high teens. So it's a striking comparison that an investor has to choose from, and that is certainly a second point, which I'm sure would make the investor base a bit careful about these companies. Now, of course, these are in different stages of their life cycle. So Meituan started somewhere around 7 to 8 years ago, and it has reached a degree of maturity. So the growth is not really as high as that of Swiggy or Zomato. But it's at some point of time, even the Indian quick commerce companies would reach that stage. And the question to ask is, how far away are we from that moderate growth stage, as far as the Indian companies are concerned?
All right. Hi, Manishi. Good morning. Good to see you, Win. Well, the Indian markets actually have been resilient, right? We had geopolitical issues. You've had Trump's tantrums or tariffs, whatever you'd like to call it. You have the regulator that's tightening the screws and volumes are down. And still we're at around 25,000. What's your sense, from year on, in the next 12 months or so? Could the Nifty be much higher from year on? Are we entering the next phase of the up move? Because the RBI as well has solely focused on growth. Inflation's under control. That's another booster shot. Your take.
Right. So let me break down that question into 3 or 4 different parts. First, India is in a very curious position right now. If you look at the macroeconomic fundamentals, they're actually quite good. You have declining fiscal deficit, you have a sharply declining current account deficit, which is hardly about 1% or so. You have sharply declining inflation, CPI came out at 2.1%. So these markers of macroeconomic stability, they're actually doing fine. The problem is with the micro, where earnings growth is disappointing. Almost every quarter, almost every month, earnings estimates are being brought down. So what we thought would be a 17 to 18% earnings growth year, fiscal 26 and 27, now looks like it'll be about a 14 to 15%, maybe even a percentage point lower. So this is what the investors are grappling with. So the real enthusiasm for India would really come back when we are able to put this period of earnings growth estimates being whittled down, when we're able to put this period behind us. When would that happen? That's $1 million question, possibly late this year, when the impact of government capex increasing gets felt again among the industrial companies, when the impact of RBI's jumbo rate cut and possibly 1 or 2 more going forward begins to be felt among the consumers. It usually takes about a couple of quarters or more. So I'm thinking about the last quarter of this calendar year when the earnings estimates would bottom out and then begin to increase again. And now I'll come back to your first point. On an isolated basis, India looks like very resilient. Yes, it has held on to that, about 24,500 to 25,000 for the Nifty, somewhere around 80 to 82,000 for Sensex. It has increased. It has appreciated hardly about 2.5 to 3% this year. Look at Asia ex Japan. MSCI Asia ex Japan is up 14%. If you simply bought an ETF on MSCI Asia ex Japan, which is almost a zero-cost ETF, you would have made 14% in 6 months, and that's stupendous returns. So in comparison to its Asian markets, India hasn't done really all that well. And, I think that is something that we have to look forward to.
Like they say, gains beget gains, success, brings more success, right? So eventually, once we get our mojo back, then everyone will come. That's what's happened in the past as well. But we'll see. Earnings have to pick up. Take that point, Manishi. Great conversation as always. Thank you so much for joining in. And we look forward to the next one. Quick pit stop to check the market before we get to our corporate conversation. Holding steady on the Nifty, 30 points higher, but mid-caps are a little wobbly. Mid-cap index is flashing red now. Just a bit of profit-taking coming in on that side of the market. But anyway, let's move on and discuss more earnings and more corporate commentary. Angel One is the next company on our radar, and it reported an operationally slightly weak quarter, you can say. The company's profitability was impacted by IPL expenses and higher employee costs. In fact, some ESOP costs as well that they had to take on board. We have Amrish Kengi, Group CEO at Angel One, joining in to give us an outlook on the business. Amrish, great to have you. Thanks so much for being with us. It's interesting. I was taking a look at all your parameters as well, and the market has gone through so much of regulatory change, right? So April, May, June, the average daily turnover is kind of hovering between 35 lakh to, in the good months, about 30, almost touching 38 lakhs as well, or 37 to be tops. Your overall revenue has managed to grow 8%. But there's still a lot of chatter. There's some chatter in the market that there's more to come. Maybe they'll change the weekly options expiry timeline from weekly to fortnightly. So how do you sum up the performance and revenue growth in this environment? And do you expect more in terms of F&O regulation, particularly on the weekly expiry side?
Hi, good morning, Surabhi. Thanks for having me here on the show. I think, look, we had, a solid execution quarter. You mentioned 8% revenue growth. When you look on an adjusted or normalized EBITDA basis, we actually grew by 30%. On a normalized PAT basis, we grew 26% quarter over quarter. So solid execution quarter. We've given this guidance before also that I think we were bottoming out in Q4 last year, and this Q1 we are showing that there is clear growth there. In terms of what you mentioned about the macro, I think in the short term it's been a little bit of a perfect storm, right? As you know, you've got some of the, of course, regulatory changes, which I think in the long term are super helpful because it makes the ecosystem stronger. But of course, we had the tariff conversations, the Pakistan escalations, you had the sort of war in the Middle East. So all of those things, despite that, I think the market has been fairly resilient. In terms of what is coming next, I think it's kind of a fool's errand to try to predict that. I do think that the regulators have balanced it quite well. I think they're continuing to balance both the trust that the consumers have in the market, but also balancing the growth of the market and making sure that you got the right set of price discovery, you have the right set of instruments in there. So I think I don't want to sort of predict what the regulator would do next, but all the conversations that I'm seeing, I think they're being very balanced about how they think about the retail investors as well as the markets overall.
So can you give us some, I don't want to speculate on this, but just to know, in case something like this does develop, if the product is changed from being a weekly product to a fortnightly product on the option side, to what extent can that impact your revenue and overall volumes?
It's hard to exactly predict how consumer behavior changes. I think that's like the holy grail in any case. But what I can tell you is that, look, if you look at our earnings, about 45% of our revenues came from F&O broking. So while people may think it's a very large amount, people think it was probably even larger, but it's really only 45% that's coming from F&O. In terms of fortnightly expiries and changes like that, I think it all depends on the nature of it and how it is implemented and executed. But I don't think there is any indication from the regulators. So I think there's a lot of chatter, but I haven't seen any specific indication from the regulators. So my suggestion would be, I think we should just wait and see what happens there.
Right. Amrish, hi, morning. Prashant here. Now we're talking about the numbers for April to June, right? But early July, we got SEBI, which came out with that order on Jane Street. Now, I don't want to talk about a specific entity, of course, but they were such an outsized contributor to volumes, etc. And somebody was, a lot of people are saying, well, volumes are down since then. And maybe they are because, of course, what they were doing, but also because of others doing what they're seeing in the market, and that what was happening in the market was being caused by this one entity. So, participants had to adjust their positions in response to what was happening in the market, which was in turn being caused by this one entity. So volumes are down. Can you give us a sense since then? Because this is, we'll get a real sense of what's going on, since that order.
Hey, Prashant, good morning. I think anything like this does create a little bit of a shock in the system. Again, and it's a large player we are talking about. And a sort of a very significant order that was passed. In the short term, I think you always see, you always see certain good things happen. You see exuberance. In the short term, when something like this happens, there is a bit of a shock to the system. What I can personally see is actually there's been some recovery since then. From we of course will publish. We are probably the only entity who publishes our numbers at the end of the month. You'll see orders and everything come out. I do see some recovery from that. I think markets are not dependent on just one entity. I think there is a lot of, of course, there is, FPI is making investment, but you see a lot of DII.
Ambrish, if just to get a sense, and you said, we're almost at the end of the month, so maybe I'm asking you to give out the numbers before you publish them. But to the extent that you can, say from a baseline of 100, where are we now post the Jane order?
Look, I don't want to.
Are we at 80? Are we at 70?
Pressure.
Where are we?
I wish I could give you those numbers. I don't want to sort of jump the gun because I think it ends up, things end up changing across the month. There are different sort of ups and downs that you do see during the month. I do think, you see the sort of markets recovering. You're seeing some of the things recovering. I can't comment on exactly like what percentage impact these things have. That's hard for me to say. And we don't worry about day to day as much. I think we really have to worry about the fact that and celebrate the fact that overall macro fundamentals haven't changed. Like when you look at the next 3 to 5 years, nothing has changed. I think India GDP is growing phenomenally well. The demographic dividend is in place. How you see retail investors have grown both in derivative participation as well as overall equity. Like you see overall equity, right, over the last 5 years, I think investment in equities has gone from like 16 lakh crore to like 70 lakh crores. So that is continuing to happen. So I wouldn't worry about sort of the daily or monthly gyrations. That's, that sometimes ends up giving the wrong perception.
All right. Hi, Amrish. Good to see you in. Nigel on this side. Let's get a couple of numbers, though. You've taken us through the macro, some parts of the micro as well. Let's focus on margins first. It missed street expectations, right? Because of that 47% jump that we saw on a sequential basis in employee cost. Because of the stock options. You're also scaling new verticals, asset and wealth management and the likes. Given that, this employee cost has spiked up, it could be a little bit sticky, scaling into newer verticals. What is the outlook on margins on a blended basis for FY26? It's been declining for 3 straight quarters, so I ask you this question.
So Nigel, hi, good to see you. The way you have to look at it is that if you look at our earnings, you would look at some normalizations that we have done. So the last quarter looked, the employee costs looked a little bit lower because there was a one-time adjustment we had taken for variable pay. So therefore, you saw that, that's why you're seeing that kind of appearing as increasing. But once you adjust, the cost actually hasn't gone up as much. And if you look through earnings, it's almost sort of flat from Q4 to Q1. In terms of margins, if you adjust, if you look at the adjusted EBITDA margins, that would come out to 34% once you adjust for IPL costs and this employee costs that I talked about. So that's been sort of a healthy margin. We do think that margin will increase from here and in Q4 get closer to 40% margin. So that's something that we've given guidance on. At the same time, we are a big believer in long-term investments. Angel One, you guys are aware of it, but your viewers may not be as aware. But Angel One has been a company that's been around for 30 years, and actually in some form even more than 30 years. And we've been able to transform ourselves with all of these, changes that have happened, and we've transformed ourselves into a sort of large technology company at this point. But you're also seeing us diversify. So if you look at wealth management, if you look at that AUM, that's grown very healthy. It's more than 5,000 crores now. On the AMC side, you saw that our AUM went up more than 340 crores, and it's very early days and it's growing well. On lending distribution, our lifetime so far was 700 crores. We added 230 crores more of that distribution, and you'll see that. So while we are transforming ourselves continuously into a technology company over a period of time, but you're also seeing us diversify. And all of these seeds, once you sow them, they're going to show you much more later on. And we look at it like a 3 to 5 years.
Okay. Absolutely. Sorry, Amrish, so sorry cutting you short. Earnings seasons are just back to back. But very quickly, if you could just leave us with some numbers. One important number is you're saying your margins will get back to 40% by the fourth quarter of the current year. You're also investing in the wealth business and some of the other related businesses. So what is the total investment you've planned? And what should be a top-line expectation for FY26 full year?
So we don't talk about specific investments in those areas. We are not breaking it out right now. As we go along, we'll break that out. Same thing with the top line. I think it's very, very early investments right now, so we don't break them out. We broke out our revenue in terms of distribution, that's 3%. But wealth and AMC, it's still very early days, and it ends up being back-ended. You invest first and you end up getting revenue.
You reap profits later. I mean, the wealth business, of course, is booming, has been booming. So we'll look forward to touching base later on it. And, of course, look forward to the end of the month numbers, as you said, right, for that full month impact. The lack of Jane in the system. And what is the impact on orders. Amrish, thank you very much. Good luck. Appreciate you coming on this morning here on CNBC-TV18 for that quick conversation.
Thank you very much. Really appreciate it.
All right, PNB Housing is on our radar. First quarter was a healthy quarter for them with profits above estimates and good growth in loan book and disbursements. To talk about their first quarter performance, Girish Kausgi is Managing Director and CEO at PNB Housing Finance. He's with us. Girish, great to have you with us here. Thank you very much for your time. Prashant this side. If I can start by asking you, Girish, how much of the rate cut impact is already, have you taken into account this quarter? How much is left to be accounted for in the next couple of quarters? NIMs have remained stable sequentially. And I think your guidance is now about 3.7% on the net interest margin front. What gives you the confidence? Just break that down for us.
Sure. Good morning, Prashant. So if you look at repo cut in last 6 months, it was close to 100 bips. So in our cost of borrowing, we could see a benefit of about 8 odd bips. So we will be passing on 10 bips effective July. So we have baked that into our Q2, and any further cuts, we will figure out what is the benefit we are getting, and then we will try to pass on the benefit to the customer. So we are pretty much confident on the NIM. So earlier the guidance was between 3.6 to 3.65. Now we are upping the guidance to around 3.7% NIM. So we are pretty much, we are very confident. What gives this confidence is basically because if you remember, we are now trying to move segments. Our focus is now more on affordable and emerging. If you look at the origination in quarter one, it is close to 50%. And on book now, it is about 37%. So by FY27, we expect it to cross 50%. So 50% of the book will be affordable and emerging. So in each of these segments, that is prime, emerging, affordable, and the loan against property, the new vertical which we started this year, in all of these segments, our attempt is to try and increase the yield. And therefore, we are very much confident on NIM being stable at around 3.7% for this year.
Okay, all right. Hi, Mr. Kausgi. Thanks a lot for joining in. So your focus clearly has been on emerging as well as on affordable segments. And as you said, it comes as a better yield. No worries, though, on asset quality? Everything stable on that front?
Yes, I think last quarter, the asset quality GNPA was 1.08. Now it is 1.06. I think going forward, we'll be able to maintain between 1 to 1.1 on a steady state form.
Okay, what about, let's clear out a couple of numbers. What kind of growth guidance can you give us for the year? And you've gone ahead and upped your NIM guidance, I think, a little bit by around 10 basis points. Give us the guidance on both those two numbers.
On retail loan growth, we have guided 18%. We stick to our guidance. Maybe it could be slightly better by end of the year. In terms of NIM, it was initially 3.6 to 3.65. We are very confident and therefore we have upped the guidance. So it will be around 3.7%.
And the retail book you had mentioned earlier, you see it going to 1 lakh crore. Which quarter does that happen?
So this will happen by March 2027. The retail loan book will cross 1 lakh crore.
Mr. Kauski, hi, good morning, sir. Great to have you on. So just trying to understand, since you're focusing more on the retail book, could that growth be higher? Could it eventually lead you to perhaps even surpassing your own guidance for overall AUM growth this year?
It could. So which is what I mentioned. So we have guided 18% book growth
for
on
retail.
And with the market, see, as of now, market is quite robust. It is very good. Quarter one being cyclical, you might see most of the companies, posting lesser growth on disbursement and lesser growth on book. This is quite normal. No, you take any year, quarter one will be muted. Otherwise, demand is quite robust. We see very good opportunity in all the segments. But our focus is more on emerging and affordable and, of course, loan against property. So there could be chances that we could surpass a guidance of 18%.
Where is the ROA headed, sir? This year, negative credit cost guidance is what you have given. On a steady state basis, how do you see the ROA scale up?
So I think currently, if you look at this quarter, we are at about 2.57. So it will be around 2.5 to 2.6 in that range.
Okay. All right, Mr. Kauski, thank you very much for joining in. Really appreciate it. And good luck to you with all of those plans. Very, very steady start to the year and pretty steady guidance on margins and growth. Perhaps 18% on the retail book and maybe more than that overall as well. That's PNB Housing. Well, in a minute from now, we'll put the spotlight on the pharma space. What can the first quarter earnings season herald for the pharma sector? We'll talk about that as we go on. Just a quick check on the market. It's still very, very stable. Not too much has changed. The headline of the day continues to come in from obviously the food delivery and the quick commerce space. Now that little freeze that happened on Eternal, that obviously opened up, and now the stock's up about 11%. Swiggy is up 5%. So those are the big movers of the day. And some of the larger banks, they started the day on a positive note, still continuing. 0.5% up on HDFC Bank and ICICI Bank up 1%. So some of these big stocks are keeping the Nifty's head above water, 40 points up overall. I think we can take a quick break. We'll take that break, come back. We'll have Ekta joining in and the analyst from Prabhudas Liladhar to tell us what the first quarter could spell for the pharma sector.
Well, it's time for our special segment, Quarter Se Quarter Tak, where we bring you expectations from each sector. Today, we turn the spotlight on the pharma pack. Ekta joins us to help us out with what are the expectations. Ekta, take it away.
Thanks for that. Well, for pharmaceutical stocks as well as healthcare stocks, expect a steady quarter. Now, for pharma companies, you are expecting around a 10 to 11% growth in revenue and a growth in EBITDA, which would be similar this quarter, along with profit between 5 to 10%. Now, expect the US growth for generic companies estimated at around 3 to 4% Q-on-Q. Growth X of Revlimid generic would be something to watch out for. Now, overall growth in the US would be led by stability in US generic pricing, volume growth in existing products, and a pickup in recent launches. Expect lower Q-on-Q sales in Revlimid generic for companies such as Aurobindo, Cipla, Dr. Reddy's, Sun Pharma, according to analysts, as price pressure increases. Now, for Sun, watch for the specialty portfolio growth. That would be the key thing to watch out for. For Biocon, watch for growth in the biosimilars portfolio. Now, the range for domestic growth is wide, anywhere between 8 to even 16%, according to some analysts. Now, domestic-focused firms such as Torrent, Ipca, Alchem expected to see good growth this quarter. And watch for commentary on Torrent's acquisition of JB Chemicals. Now, most API companies are likely to see a volume uptick this time round with an estimated 8 to 9% growth year on year. Expect over 15% growth in some CRDMO companies driven by the likes of Bluejet, Divi's, Laurus Labs, Sai Life Sciences. While Syngene and Piramal Pharma could probably see a muted quarter due to inventory destocking on key molecules. Now, moving on from pharmaceuticals to the healthcare front. On the healthcare front, expect around a 20% growth in EBITDA, driven by over around 20% growth in hospitals and around 10 to 11% growth in diagnostics as healthcare companies recover after a softer Q4. Apollo hospitals might see continued impact of international patients slowing from the likes of Bangladesh. Commentary on the recent restructuring will be watched. Expect steady margins for the likes of Dr. Lal's. Watch for recent acquisition integration for Metropolis, which has been on an inorganic drive. Now, let's leave you with the valuations. First, for the pharma stocks, as you can see, Sun Pharma ruling the roost, most expensive, along with a couple of others such as Divi's Labs. So a lot of probably the good news is factored in. For diagnostics, Dr. Lal's as well as Metropolis, FY26 PE stands at around 50 odd times. And finally, for hospitals, the likes of Apollo Hospitals and Max ruling the roost in terms of valuations there.
Okay, all right, got it. Ekta, thanks very much for prepping us up with the pharma and healthcare report card. Let's take this forward with Param Desai, who tracks the sector at Prabhudas Leeladhar. Param, great to have you on. So what's your sense? I mean, hospital stocks anyway have been doing really well. But if we talk about pharma, with so much going on and still this sword hanging in terms of what the eventual US policy is going to be with respect to import of generic medicines, let's start right there. I mean, in terms of just pure earnings growth, best-in-class earnings growth, which company will deliver in the first quarter?
Hi. Overall, if you see US, the growth will be slightly on a softer side. The base is on a higher side, given the Revlimid. And we are seeing most of the companies Revlimid, there is an erosion on a Q1Q basis. So on a largely in a large cap side, whoever's having a higher Revlimid exposure will have a slightly flattish growth in the US from a YY perspective. Having said that, I think domestic pharma will be a pretty steady quarter. For most of the guys, the growth will be in the range of 8 to say around 13% among our coverage universe. The acute season has also been started pretty well. So slightly acute heavy companies like Alchem, Ipca, Mankind should do well during the quarter on a YY. But net is the US, which is basically keeping the growth slightly muted on the pharma side.
So I take your point on Revlimid, and that's where that high base will come and play a part. But X of Revlimid, overall, when you talk about US business volumes, then what's the picture like? And from large cap pharma perspective, again I go back to the growth question: which company could deliver the best in class growth?
Yeah. So from an X of revenue, the base business I think should be a steady. There should be some price erosion, specific product specific price erosion will be there depending upon the competition. But overall, I think the price erosion continues to in a mid single digit. So we expect the base business X of revenue to grow on a YOY basis. Among our coverage unions, from a Q1 perspective, I think Lupin will see a highest growth YOY, largely aided by one of the product called Tola pattern where they have an exclusivity. Barring, I think, Lupin among our coverage, the growth largely among the large caps is largely a flattish on a YOY basis.
Okay, so that's as far as growth is concerned. Just run us through some of your favorite top picks and why, and also throw in that margin perspective. I mean, we've discussed growth. From a steady margin to maybe even a growth in EBITDA margins, is there anyone to watch out for in Q1?
Yeah, so margins largely will be pretty much steady. If you see the raw material prices continues to be pretty benign. So gross margins will continue to remain healthy for most of the guys. Yes, there could be some kind of margin erosion because of kind of a Revlimid-led erosion. Otherwise, margins are expected to remain pretty much steady across the majority of the companies. With respect to our topics, we preferred on the pharma side, we prefer Sun, Lupin, among the large caps and DVs and Eris. These are the preferred names in the large and the mid cap names. So Sun, clearly, I think the story on the specialty side, we are structurally very positive on that space. I think they have interesting pipeline to go out. Two launches lined up in this year, and beyond 26 also they have some good pipeline to play. So specialty is a segment which will drive in case of Sun. They have a less dependency on the US generic. So that is clearly a preferred pick among the large cap names. Followed by Lupin, which has a zero Revlimid exposure, and they do have an interesting US pipeline with a couple of products on exclusivity side this year. And beyond FY26 also, they have some couple of niche launches in the US, which will drive their overall growth story beyond 26 also. So these are the two names among the large cap. And in the mid cap, we like Eris. It's a pure 85-90% domestic play story. Some of the inorganic initiatives what they have taken last year, I think that has been shaping up pretty well. And there is also a GLP story which will come into play in case of Eris from 27 onwards. So I think we almost see PAT getting double in the next 2.5 years in case of Eris. So this is one of the name which look in the mid cap name.
So Sun Pharma, Lupin and Eris. Sun, yeah, there was some positive news, the news flow on their Illumia drug as well in the next phase of trials, I believe. Very quickly, Param, finally, hospitals. Apollo Hospital has been a dream stock for many in the market. I think it's still your top pick, but, do you like anything else? And again, from an investment perspective, should more money go to hospitals, pharma, split it up? Just quick final take.
Sure. So we have structured very positive on the hospital space. I think even this quarter, if you see the growth is around 18 to 20% EBITDA growth. So another quarter where the growth remains pretty much steady. So we prefer hospitals over pharma, given the kind of growth profile. And the important thing is next 3 to 4 year journey in the hospital is largely aided by the bed expansion. Most of the guys are almost doubling the bed in the next 4 to 5 years. And this expansion is largely coming function of brownfield, inorganic and greenfield. So that will not drag the P&L, which was the case in the last capex cycle. So we remain structurally very positive. We see around 18 to 20% of EBITDA growth story to continue in the hospital space. And among our preferred picks in the Apollo, KIMS, Jupiter, these are the preferred names in the hospital space.
Apollo, KIMS and Jupiter. Thank you very much. Good speaking with you there and getting that perspective, Param. So that is the sort of healthcare and pharma space on the back of the earnings which are expected from the space. Let's talk about markets which are now absolutely, they've gone back to being flat on the Nifty. Just under 25,100, 25,090 or so is where the Nifty is trading at. But it's not as if stocks are not moving. They are. I mean, Eternal and Swiggy remain the top movers. Angel, we just spoke with the management, is the number 3 volume-led gainers list. 4% there. Info Edge is up 4%. Tilak Nagar, MRPL. I mean, there's enough happening on a single stock basis. Religare has started moving higher as well. So about 280 odd rupees on Religare. There's India Cements, which is up about 2% Gabriel, 6% move on Gabriel on decent-sized volumes as well. But what should you do in terms of trades now? As always, Mitesh is back with us with that. Mitesh, morning again. What do you have?
So I have one buy and one sell call right now, Prashant. I think Canara Bank and the banking pack is looking slightly weak. So Canara Bank for me is a sell with a stop at about 113 and a target of around 104, 103 half can be looked at. And UPL, it's done well. Yesterday there was a good movement. Today there's slight pullback. So around 710, try to buy into this one with a stop at about 695. Look for targets from 745.
Okay, all right. Well, thanks a lot for that, Mitesh. Let's focus on some stocks, though, that are moving around. Ria's with us to tell us about AGI Greenpack, which is reacting positively to its numbers. Ria?
Well, yes, Nigel, AGI Greenpack has come out with its Q1 numbers yesterday. In terms of the revenue, that has gone up by around 21% over the previous year. The EBITDA and net profit have also jumped up by 20% and 40% respectively, although the margin has contracted by around 37 basis points. But coming to the important news flow here, the company has diversified into the manufacturing of aluminum beverage cans. They are going to build a new facility in Uttar Pradesh for this, and the capacity will be 1.6 billion beverage cans per year once they finish the entire capacity addition. In phase 1, they're going to add around 950 million cans, which is planned to start by Q3 of FY28, and in phase 2 will be implemented by the end of March 2030. Now, the total capex for this is rupees 1,000 crores, 850 crores in the first phase, and the balance in the second phase. And this is going to be funded by a mix of debt and internal accruals for the company. Now, the management has also said that they are entering this segment with a clear goal of becoming the top player in this segment within the next 1 decade. And remember, at the end of Q4, the company had also given guidance for the full year of FY26. Revenue growth target is at 8 to 10%, and EBITDA margins will remain in the range of 22 to 25%.
All right, got it, Ria. Thank you very much for that. That's AGI Greenpack. But let's get back to the stars of the day. Has to be Eternal and Swiggy. And I think in a related excitement, even Info Edge, last I checked, was up some 3-4%. Mangalam's back with us. What a move, Mangalam. It's really silenced its critics, at least for this quarter.
What do they say? When it rains, it pours. And that's exactly what has taken place when it comes to, Eternal. If you look at the last couple of trading sessions, the stock going into the numbers was about 15% away from its record high. And today morning itself, post-opening, the stock has gone ahead and hit a fresh record high for the first time in the last 6 months or so that I remember for Eternal. And there are a couple of reasons for that. One, the initial sign of the numbers told you that the worst is behind, and thereafter the management came and confirmed that in the food delivery business, growth seems to have bottomed out, and from here on things are looking on the mend. Even quick commerce, despite the competition that they've seen, perhaps the worst is behind in the near term for the quick commerce margins. And these are businesses that are growing, at least on the quick commerce side, over 100%, and has now become the biggest contributor to the company's overall revenue as well. Earlier, it was just the biggest contributor to their valuation. The third engine, which is District, is likely to be a $3 billion business over the next 5 years as well, with $150 million adjusted EBITDA annually. All of these has the brokerages fairly excited. Jefferies has upgraded the stock to buy. They have a target price of 400. CLSA has a high conviction outperform, a target price of 385. Goldman Sachs, 340 rupees, positive on the stock. And Bernstein too has raised their target price to 320. When Zomato runs, it's not just that, because you have a comparable company on the bourses as well. Swiggy is higher as Eternal management expects growth to return. So the growth is returning for the sector. Swiggy stands to benefit as well. And the only thing that plays out between Zomato and Swiggy is the valuation discount. Swiggy currently is at a 45% discount to Zomato when it comes to price to sales valuation. So that stock catching up as well. And finally, you have Info Edge. They invested about 13%, or they hold about 13% stake in Zomato as of June 2025. And their stake after this up move is all the way up to nearly 40,000 crore rupees, or $4.5 billion. What does Info Edge's own market cap look like right now? It's around 94,000 crores. So nearly 35 to 40% of Info Edge's current market cap could be valued as holding in Eternal.
Absolutely, Mangalam. I can tell you when customer preferences shift so quickly without we even realizing it. And as a customer, I'll say maybe District was a masterstroke. It's a one-stop shop. Now you don't hop across multiple apps, whether it's movies, booking a restaurant seat, going to a concert. It's all on your District. So, whoa, what a strategy really
The
there.
interesting thing is if you just look at the Swiggy shareholders letter and look at the cover, that tells you exactly what the company is all about. And this is Eternal, right? So if you look at the shareholders letter, they have 3 pictures. On one, there is a hoarding which says, Aaj kya khaoge? On the second, there is a hoarding which says, Aaj kya mangwaoge? That's Blinkit. And the third one is, Aaj kahan jaoge? Which is District. So What do you call for in your house? What do you eat? And where do you go? All of that in Eternal.
Absolutely clear. And I myself am a customer that's getting completely captured in that ecosystem. I find that happening and in a very subtle way as well. Thank you so much for joining in with the details over there. But guys, we have Nimesh now joining in. And he's got a very interesting analysis. Actually, let's go across to the wall because Nimesh has been looking at a lot of data that kind of ties in the perspective with what happens to stocks and companies when there is a change of guard. So is there a clear correlation? Let's ask Nimesh.
Oh, absolutely, Surabhi. We've discussed in the past as well that normally when we see a leadership change, it's a case of a re-rating for the stock as well. So I've looked at the data since the start of 2021, and this is a BSE 500 data. Across the BSE 500 companies, more than 100 companies have seen a change of guard in the last 4-5 years. And interestingly, more than 20 companies have seen a stock price reaction between 30 to 200%. So that's the kind of reaction you see in the stock price or the re-rating that you see in the stock price. But there are some companies which have given more than 200% return as well in the same period. So I'll start with that list first. The first stock on my list is Persistent System. Look at the kind of reaction to the stock price. The stock is up 850% since Sandeep Kalra took over as a new MD and CEO in October 2020. 850% in the last 4 years. That's the first stock. We've seen a big reaction there. Next in the list is, this is not Persistent System. The second on the list is Newgen Software. They got a new CEO in 2021 and the stock has reacted 285%. The third on the list is Himadri Chemicals. That stock is up 500% since the new CEO came in 2022. Again, a big move there. The next stock is Zensa Technologies. Even the company saw a new leadership change in 2023, and since then the stock is up 275%. These are the few names which have rallied between 300 to 800% in the limited period of time. So that's the kind of data which proves that a leadership change leads to a big re-rating. Remember, this is the BSE 500 data. If I look at NSE, one stock which will stand out for me is Bombay Stock Exchange. It's only listed in NSE, and we've seen a massive reaction to that stock price as well, but that doesn't show up in the data. So now the question is, will the history repeat itself? And that's something to watch out for. Which are the few companies where there has been a leadership change announced, and can that stock see the re-rating in the near future? The first on my list is HUL. A woman CEO now, Priya Nair, has been appointed as a new CEO on July 10. So need to see in the next few quarters whether you see a big re-rating in the stocks like HUL. The next stock is Cyient. Even Cyient announced a new CEO in February 2025. The stock is still not reacted, but we'll have to wait and see as to what the strategy is for Cyient going forward, and will the stock react or re-rate further from here on. Titan, we all know that there is going to be a fresh change of guard from January of 2026. Across the various verticals, you're going to see new CEOs in Titan as well. So Titan will be the stock to watch going forward. Across, as I said, watches business as well as jewelry, there are going to be new CEOs there. The next on my list is Cyient DLM. Again, they've appointed a new CEO in July 1st. So again, fresh appointment, but we'll have to see whether going forward, even that stock re-rates or not. And the last but not the least on my list is Max Financial Services. Sumit Mandal has been appointed as a new MD and CEO of Axis Max Life, which is the insurance arm of Max Financial. They're going to see a new CEO from October of 2026. So again, massive changes are happening, and we've seen big reactions to the stock prices as well. History suggests a change of guard leads to re-rating. So we need to see if there is a fresh change of guard in many companies. Only recently we saw a big reaction to something like, for Arvind Fashion as well, right? I mean, we saw a big reaction to that when they appointed a new woman CEO. So history suggests that a leadership change normally leads to a big re-rating in the stock price as well.
Okay. And we'll have to see if history indeed repeats itself. And that's amazing, right? Because a lot of these companies are from the consumer space as well. The ones where there'll be a management change and at an interesting crossroads, at an inflection point, perhaps, when it comes to growth. If you want more
perspective on this, Nimesh, Surabhi, you should log on to
CNBC-TV18 Access.
TV18 Access.
Correct.
And you can find a full 35-40-minute discussion on this, various perspectives.
Yes.
But you have to have access.
Leadership change, what that may mean for companies and for stock prices. Well, speaking of stock prices, by the way, that's important news flashing on Tata Power on your screens. Just keep sight of that. All 5 units of Mundra are going to go in for a planned maintenance shutdown. IIFL believes it could lead to about a 6% hit on FY26 profit estimates. So, yeah, stock's down about 0.5%. Take a break on that note. Come back on the other side. We'll have Manisha joining in with the latest on the commodity markets. Welcome back. Well, the equity market has quietened down, but let's train our eyes now on the commodity markets. We have Manisha joining in. Manisha, so tell us, what's the headline today? What are you watching?
Well, I'm looking at metals for a second straight day. The kind of gains that we saw yesterday is not what we are looking at today. But the important point is that we are still trading on the higher side, and we still are at around multi-week to multi-month highs. So overnight markets have seen steel prices gain up by a percentage point, and with that, we're trading at a 3-month highs. Good gains coming in for nickel as well after a very long time. By the way, it's a percentage point higher at a 6-week highs. Iron ore prices are your gainer, by the way, because in Shanghai, in US markets, we've seen very strong gains come in for this one. And overnight has been yet another 3% of gains, and that has taken the iron ore prices to a 5-month highs. Other metals also have seen a spillover effect because of that. So you have zinc and aluminum prices gaining 0.5% per piece, and 3 to 4 month highs coming in for these as well. It's not just about the base metals and the ferrous metals, but we also have seen the precious metal prices gain up, by the way. So if you look at platinum, that was at 2.5% on the higher side, and near 2% of gains coming in for gold and silver as well. So while we are trading very close to multi-year highs in case of platinum and silver, gold prices hitting $3,400 an ounce is a 5-week highs coming in for this one as well. Well, the metals are supported because of one point, and that is the dollar index, which has slipped below 98. That clearly has been supportive. And then traders are pricing in a 60% chance of a rate cut for the month of September. That also seems to have given a new lease of life when it comes to many of these precious metal prices. For industrial metals, it all comes in from China. Remember, the economic data that we've seen come in from US has been positive. And from China, the construction of world's largest hydropower dam in China has begun. And China has been putting out statements and updates onto that, and that has been supportive. Well, to tell you, the largest dam is estimated at a $167 billion, and a lot of steel, and that means iron ore and nickel, and then construction, when it means that, would also need other metals as well. So this is going to require steel and various other metals, and that has been supportive. In any case, China has said that they will continue to issue more of such construction projects. They are looking to reform industrial policy to align to their overcapacity, and a Chinese stimulus measures is what the street also is awaiting for. So all of those factors very, very supportive for the metal prices going forward. What the street will now also want to watch out for is the EU-US trade negotiations in this week, if any final statements come in from that. As of now, we're working with 30% of tariffs that could be slapped on European Union. And then it is also about the ECB policy meeting, where the expectation is that the interest rates would be kept steady at 2%. And finally, the US Fed policy next week, well, it's not going to be changing anything in interest rates, but any guidance statements from Jerome Powell is what the street will react to.
All right, Manisha, thank you very much for that. We'll take a quick commercial break here. On the other side, Lata is going to be speaking with the management of UCO Bank on the back of their first quarter earnings. Stay tuned.
Welcome back to Corporate Radar. UCO Bank has reported a good set for the June quarter with advances growing by 16.5%, deposits by 11.5%, both well above the industry average, even if lower than their own previous quarter. The net interest margins have fallen, but by only 4 basis points to 3.18. On the other hand, slippages have gone up a bit from 1.08% slippage ratio in March quarter to 1.18 this quarter. There is also a slight fall in return on assets and return on equity, which would bother investors. Joining me to discuss these numbers is the Managing Director and CEO, Mr. Ashwini Kumar. Mr. Kumar, good morning, and thank you very much indeed for joining me. Can you tell us what will be the progress in terms of both loan growth and margins? Your loan growth is lower compared to the last quarter. One can understand that. The March quarter is always a busy quarter. But can you steady yourself at around 16% loan growth?
Thank you, Lataji, for having me on your show. First of all, let me share with you that for last 2 years, we have been growing in our advances and deposit growth also. Deposit growth last year, we were not growing much because our CD ratio was lower. So this year, we have started looking at the deposits also, and you can see that the March quarter and this June quarter, our deposit growth is more than 11%. So, and that momentum will continue because now we have achieved our CD ratio of 75%. Going forward, if you look at our advances growth, last 4 or 5 quarters or 6 quarters, we are growing our advances, and this advances growth is mainly coming from retail, agri and MSME segment. And that segment still continues in this quarter also. Our home loan growth was around 18%, vehicle loan was 66%, MSME grew by 20%, and agriculture 15%. So these are the 3 engines of our growth which are growing at a good pace. And I expect that these growth momentum to continue because our 3,300 franchisee in the field branch network is working towards reaching out to retail customers, agri and MSME. So this growth momentum will continue.
No, your growth momentum, you have guided for something less. You're guiding only for 12 to 14. So you think 16 is tough to maintain?
See, guidance is always on a conservative basis. Last year also, if you look at our guidance was 12 to 14, but we achieved more than 17. But looking at the current market scenario where the credit growth has slightly come down, though the guidance continues to remain 12 to 14%, but being small in our base is a little small. So I expect we may surpass the guidance.
Okay. What about margins? You've managed it very well in the current quarter. Almost every other bank has lost from between 7 to 27 basis points in terms of impact on margins. Will there be more now that the full 100 basis repo cut comes into force? By the way, how much of your loans are linked to external benchmarks?
Our external benchmark loan links are around more than 50%. I think 53% are linked to external benchmark, where full transmission has happened. In MCLR also, we have already reduced MCLR by 10 bips. And next month again, ALCO will happen, and then the call will be taken about the MCLR also. So the repricing of MCLR loan also will take place a little bit. But simultaneously, if you look at the deposit market, our deposit rates have also come down, not only in the bulk market, but in the retail deposit market also. So the deposit repricing will also start happening from this quarter. And I think by December quarter, the bulk deposit repricing will be over. And by March, retail repricing will also be substantially over. So I expect that by the year end, the margins will stabilize. Maybe in this quarter, we'll see another 2, 3, 4 bips of decline in the margin, because this will be the full quarter where we'll have a 1% reduction in the repo rate. In the last quarter, we had only 1 month. So this quarter, we will have the full impact.
No, fair enough. And then after September, you will have the advantage of CRR. So what may be the exit margin? Exit margin will be well above 3. Will it be 3.2? I mean, last quarter.
See, our guidance for the margin is 3 to 3.10%.
Okay,
and we expect by March, we will reach to this level.
All right. Okay, slippages. That is the sticky point. Where did it rise, sir? I was trying to look through your PowerPoint presentation, and in slide number 33, it looks like corporates are the ones that have reported higher slippages.
See, I think it's not corporate. We have a slippage in one MSME segment, 337 crore, out of which 300 crore, total 300 plus crore. Out of that, one was mid-corporate segment. It is one account only, 137 crore slippage was there in that account. Because of that, slightly slippage is higher in this quarter, but overall slippage is within the guidance of slippage ratio we have given. Our slippage ratio guidance is 1 to 1.25. And annualized slippage ratio is 1.1 time, 1.18.
Okay, no, fair enough. Sorry, I was looking at not slippages, but SME. I'm sorry. In SMA, the only worry I have, and by the way, for those of you who don't follow this jargon, SMA is simply loans which are overdue. So SMA 0 if it is overdue for 30 days, SMA 1 if it's overdue for 60 days, and SMA 2 if it's overdue for almost 90 days. Now, what I notice is that your SMA 3 has gone up. SMA 2 has gone up from 0.03 in the last quarter to 0.3 in this quarter. Almost a 30 bips rise. And over there, I think it is the corporates which are showing higher SMA. Are you worried that your slippage will continue, even in this quarter?
See, Lataji, if you look at our overall SMA figure, more than 1 crore we report. We are the bank, we report more than 1 crore SMA figures, SMA 0, 1, 2. SMA 2 figure in this quarter looks higher because previous quarter, it was because of the February impact, it was 59 days. So certain accounts which were technically in SMA 1, actually they were in SMA 2. Because of that, if you look at our trajectory of SMA over the previous quarter, it is in the same range.
Okay, so you're saying there's no danger that this is more a technical number because of the number of days. Yes. Okay, what about the recoveries, possible recoveries from the NARCL? You have given a detailed table, but I was not able to make out how much money you will make from NCLT and NARCL. Should we expect some recoveries?
See, in this quarter, we had around 275 crore of recovery through NARCL. And one account is already under discussion, which is amount of ₹75 crore. That is already identified. Due diligence is going on. So I expect that account also to be resolved. There are further accounts which are getting identified for discussion with the NARCL in the times to come. So we expect that certain more accounts will be added in this quarter and the next quarters for the resolution through NARCL or through NCLT.
Okay. What about capital raising? Government has 90% in you. This is a damn good time for you to raise. I think you all have a 2,700 crore capital raising resolution also. Yeah. Isn't this a damn good time to raise? Should we expect something soon?
See, last year in the March quarter, we raised around 2,000 crore and we reduced our government stake from 95% to 90%. This year also, we have taken an approval from the board and the shareholders to raise QI money. And we will plan in the next quarter at the opportune time when the time is ripe. That time we will plan for coming out of our plan for taking the money.
Okay, well, you have got a damn good example from State Bank. They have managed 35,000 crore. So 1/10 of that shouldn't be a problem for you. There will be an OFS also, right? Sometime now from the government?
Sorry? Yeah,
OFS offer for sale?
Possible. There are discussions going on. I think Deepam has come out with RFP also for onboarding certain merchant bankers. Okay. So the discussions are on. Let's wait and watch.
Okay, well, just a final big question. Bank of Maharashtra is only slightly larger bank than you in terms of loans and deposits. But they are reporting a ROA of nearly 2. Of course, they had some tax write back. That was a very big advantage. But why is your ROA and ROE falling? Do you see that bottoming out? Can we expect 1% ROA sometime soon and even ROE to go back above 15?
See, if you look at our net NPA is still 0.45 and we are working to bring it further down. And our cost to income ratio is slightly higher than the Bank of Maharashtra, which you just spoke. And we are working very closely and to reduce our cost to income ratio. That is the main factor. And we are working on two things on that. One, we are working on employee productivity and we are working on branch productivity. If you look at our employee per employee business is growing on a quarter-on-quarter basis and similarly per branch business. So I think that will give us a delta in the coming quarters. And I think anytime in the next year, we'll see more than one ROE.
This is so heartening to hear. Thank you very much. We are seeing public sector banks giving private sector banks a run for their money in terms of the pace of growth, even if not in final ratios. That's a heartening sign. Thank you very much, Mr. Ashwini Kumar, for joining us. Have to wrap up on Bazaar. Chartbusters ready for you.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, markets trading with a mild positive bias. The broader markets, there is some profit taking we're seeing on select stocks. Mangalam.
A lot of stocks doing extremely well this morning. Top of the pops is Zomato. But in the broader markets, we do have, a few stocks which are under pressure. IT stocks, actually, surprisingly today, are doing a lot better after the drubbing that we've seen all of last week. So the IT index has seen a bit of a spike. We'll keep an eye out on all of that. Let's talk about Havells. That's the stock on our radar. The company faced a challenging quarter in the first quarter. Results below expectations, a large part of it impacted by the unseasonal rains and a weakish summer for some of their important summer products. We have Mr. Anil Rai Gupta